Welcome to Countouts. In this lesson, we're going to be preparing the production budget. We're going to explain what it is and go through an example which will help you understand the production budget in great detail. In our previous lesson, we did the sales budget, which is the first budget that you do in what is called the master budget. So if you'd like to check that one out, you'll find the link in the description below. We've also done other budgets within the master budget. You'll find them in the links in the description below. But what is a production budget? A production budget is a component of a master budget. Remember, there is what we call a master budget, which has got a number of budgets within it, one of which is the sales budget that I've just alluded to, the cash budget, and many more other budgets that fall within the master budget. So this is one of those where you're preparing the master budget for the entity and you have to prepare all these budgets. So the first one you always prepare is the sales budget, and then you have also what is called the production budget. This budget is prepared to ensure that sufficient inventory is always available to meet expected sales. Remember, the sales budget that I've just alluded to, that is where you will get your expected sales, and you'll need to incorporate the information from the sales budget when preparing your production budget. Alright, but this is not just to ensure that we meet our expected sales. It's also to ensure that inventory is kept at an optimal level, meaning that even though we're going to sell in this specific period, we want to make sure that we have closing inventory to start the following period. Okay, so we want to make sure that we keep inventory at a specific level. So what is the one question that the production budget will answer? Well, how many units do we need to produce in a specific period? It could be a month, it could be a quarter, or whatever the case may be, and you will see with an example that we'll be doing just now. But I want you to have that in mind. How many units do we need to produce? A production budget will show you the figures in units and not in rand amounts or dollar amounts. So that's another thing to bear in mind. So we just want to know, how many units do we need to produce at any given point in time, or for the period that we need to prepare the production budget. So bearing that in mind, what information do we need to prepare the production budget? Well, to prepare the production budget, we simply need the information regarding opening inventory, expected sales, and expected closing inventory. If we have that information, we can prepare our production budget. So with that being said, let's look at our example here. We're told that Aero Limited expects to sell the following units of product Dagesh, and we're given the details for January, February, and March, and you may notice these details if you looked at our lesson on the sales budget. And we're also told that the company aims for its ending inventory to equal 25% of the following month's unit sales. It anticipates having 2,000 units remaining at the end of December 20x4. The expected sales units for April 20x5 are 9,000. The selling price per unit of product Dagesh is 7 Rand 50. Okay, we're asked to prepare the production budget for the first quarter of the year, and we know the first quarter of the year would be the first 3 months of the year, that is January to March. Okay, so we're given all the details that we need. We're given the expected sales, we're given the expected ending inventory, and the expected opening inventory. So how are we going to go about doing this? Well, here is a very helpful format that we always use when preparing the production budget. Here we go. We have the columns here for each of the 3 months in our quarter, January, February, and March, and we have the total because we want to see how much it is in total for the quarter. And then on our first column, we've got the details, right, that we have to put in here. That is the sales units, that is the closing inventory, that is the total units required, opening inventory, and the production required. So this last line here where we have the production required simply tells us how many units do we need to produce in each particular month. That is as easy as it goes. Now, let's begin. What is our expected sales units? Now, I want you to remember that this is a budget, okay? So we are given what the expected values are. They're not giving us the actuals, okay? Because you're preparing a budget. You're not preparing the financial statements or the trial balance. You're preparing the production budget of what is to happen or what you expect to happen. So all these details are what is expected to happen for the first 3 months of 20x5. So the sales units here that we are going to put in are the expected sales units. What are they? Well, it's so easy because we are given here. For January, we have 7,000. For February, we have 9,300. And for March, we have 8,700 units. And that's exactly what we are going to put here as the sales units. How much we intend to sell in each of the 3 months. Okay, so let's put in our sales units. For January, we've got 7,000. For February, 9,300. And for March, 8,700. And we add the three together, and that will give us our total of 25,000 units. Okay, so that's what you do when you're asked to prepare the production budget. You start by putting in your expected sales units in the format or in the table you have prepared as we have displayed here. We put in our expected sales units for each of the months. You'll be given this information. You don't have to calculate it. If you have to calculate it in those rare circumstances, you'll be given enough details to calculate it. Maybe they'll tell you it's 20% of a specific month's value or 20% of the year's expected units. So you just have to do the calculation. But in most cases, you'll just be given what the sales units are. Okay, now that we have our sales unit, what is the expected closing inventory? Or for instance, in January, how many units do we intend to have in closing inventory? Meaning by the end of January, we still want this number of units in stock. Why is that important? Well, if we're going to produce in January, we want to know how many we're going to sell in January, and we also want to know how much we want to have left over in January. So that means we have to produce what we're going to sell. We also have to produce what we intend to have as our closing inventory, and that will tell us how many units are required in total. So what is our closing inventory? Well, let's see the information that we're given here. We're told that the company aims for its ending inventory to equal 25% of the following month's unit sales. Meaning, whatever I expect to sell in the following month. So let's look at January. If I expect to sell 9,300 in the following month, being February, then I need to multiply that by 25% to see how much I should have in closing inventory for January. Okay, I hope that makes sense. My closing inventory for January will be 25% of February's expected sales. Okay, so let's calculate our closing inventory for January. It's going to be the 9,300 for February, and we multiply that by 25%, and that gives us a total of 2,325 units that we need to have as closing inventory for January. So let's put that down, and I'm going to do the same thing in February. We need to answer the question again: how much closing inventory do we need to have by the end of February? Well, we follow the same procedure. We take 25% of the following month's expected sales, which is March. Okay, so our expected sales for March is 8,700, which is the month after February. So we need 25% of that to be closing inventory for February. So it's 8,700 multiplied by 25%, and it gives us 2,175 units. All right, that's quite easy. Remember, in your case, you may be given what the expected closing inventory for each of the months are, so you're just going to plug them in. So that is our expected closing inventory for February. What about March? What is our expected closing inventory? Well, we need to take April's expected sales and multiply it by 25%, and that's going to give us our expected closing inventory for March. And we're given that information. We're told that the expected sales units for April 20x5 are 9,000. Okay, so if we know we want to sell 9,000 units in April, we're just going to take 25% of that, and that's going to give us our closing inventory for March 20x5. So let's first put down for February that we had calculated 2,175, and then for March it's the 9,000 for April multiplied by 25%, and that will give us 2,250 units that we need to make sure is in closing inventory at the end of March. So we'll put that down, 2,250. Okay, what about the total column? Now you need to be careful here. You can't add the closing inventories for the 3 months and put that as your total. Why? Because you'll be essentially double counting here, because the closing inventory for January does not necessarily mean we're going to keep it as closing inventory for all the 3 months. No, it's just closing inventory for January that will help us have stock for February, and for February that will help us have stock for March. Okay, so that means the totals here captures everything for the quarter. What is my closing inventory for the quarter, or for the first quarter of the year? Well, it's the one for March, 2,250, right? So if you think about it this way, if the end of my quarter is the end of March, then I want to know what is my closing inventory at the end of March, and that's the 2,250. Okay, I hope you can clearly make sense of that. You don't add together your closing inventories. And just to tell you, opening inventory, we do exactly the same. We don't add together all the opening inventories. We just take the opening inventory for a quarter, but we'll get there just now. Now let's get our total units that we require for each of the 3 months. How many units do we require to make in January? Remember, this is a production budget. Basically, we're asking ourselves, how many units do we need in total in January? Well, we need 7,000 units that we're going to sell. We also need 2,325 units that we need to have as closing stock in January. So if we add the two together, that gives us 9,325. In February, we just add the 9,300 plus 2,175. That gives us 11,475. We do the same thing in March. It gives us 10,950. And then what is our total inventory that we require for the quarter? Well, again, we're not going to add together the total units for each of the months, okay? That means we'll be counting the same figures a number of times, which will not make any sense. What we now need to do when you're calculating your totals column or for the entire quarter, you just take your total sales units required for the quarter, which is the 25,000 units, and we add the closing inventory for the quarter, which is the 2,250, and that gives us 27,250 units. So that means in total for the quarter, we need 27,250 units. But does that mean we need to produce the 27,250 units? Not so. Does that mean in January we need to produce 9,325 units? Not necessarily. If we have opening inventory, we can just deduct what we already have and then we see what we actually need to produce. Okay? I hope it's making sense and you can see it in your mind why we're doing it the way we do. So what is our opening inventory in January? Well, we will need the closing inventory for December, unless you're told the opening inventory for January is such and such amount, okay? But in our case, what does the information tell us? Well, it says here, it anticipates having 2,000 units remaining at the end of December 20x4, meaning the previous month, okay? In December, the 2,000 units will be remaining at the end of the month. That means that's going to be our opening inventory for January. So you just have to make sense of the way the information is given to you. It will definitely be given to you. It just depends on how it's given to you. So you just have to make sense of the information and decipher what you need from there. So we know our opening inventory for January is going to be 2,000 units because that's what's left over in December. Negative 2,000 because I'm going to deduct what I already have in January to see how much I need to produce. Remember, I need a total of 9,325. But if I need that total, I can deduct what I already have in stock to see how much I actually need to produce. Okay? What about February? What is my opening inventory for February? Well, that should be easy because our closing inventory for December was our opening inventory for January. That means our closing inventory for January will be our opening inventory for February. Okay, so what is our opening inventory for February going to be? Well, it's going to be the closing inventory for January, because if we end the month of January with 2,325 units, that means we're going to begin the month of February with the same amount, 2,325 units. So I'm just going to put that as a negative in February. What about March? That should be easy for us because we've already done for February. So that means our closing inventory for February is going to be our opening inventory for March. So it's going to be this 2,175 closing inventory for February, our opening inventory for March, 2,175. Put it as a negative because we're deducting it. Okay, what about under totals? Well, I'm sure you'll have gotten it correctly. As we explained when we were looking at the closing inventory, we want to know how much did we begin the quarter with. Remember, the quarter is January to March 20x5, so that means we began the quarter in January and our opening inventory was 2,000. So I'm just going to put negative 2,000 under total there. I hope you know why we're not adding the three lines together, okay? Because we just want to know how much we began the quarter with. Now we can just figure out how much we need to produce in each of the 3 months in our quarter. Okay, in January we need a total of 9,325, but we already have 2,000 units in stock. So 9,325 minus 2,000 gives us 7,325. Now this is why you're preparing the production budget. How many units do I actually need to produce to meet my demand? Okay, that is 7,325. So I know if I produce 7,325 units, I will have what I need for selling the units and for closing inventory. Okay, because we already had 2,000 opening inventory, so we don't need to produce the 2,000. And then in February, 11,475 minus 2,325 gives us 9,150 units that we need to produce in February. And the same thing will happen in March. 10,950 units minus 2,175 units gives us 8,775 units that we need to produce. So how many units do we need to produce all together? Well, we can take the 27,250 units that are required minus the 2,000 units at opening balance, and that will give us 25,250 units. Now this is where you can also add the production required for the 3 months, and it should equal 25,250. If it doesn't, you've made a mistake somewhere. So you need to ensure that everything tallies up, and that will mean that you have done everything correctly. Okay, now here's a question. What about the selling price that we're given here? The selling price per unit of product Dagesh is 750. Well, when we're doing the production budget, we don't need the selling price. Remember, here we're just dealing with the number of units. We're not dealing with the value. We're not dealing with the rand or dollar amount. We just want the number of units. So that may be given to you, throw you off, or you may have been asked to prepare the sales budget in conjunction with the production budget, but in this case we're just asked to prepare the production budget. I hope that has made sense. I hope you've gained value from this lesson, and if you have, consider subscribing to our channel, like this video, and share it to those you think it might help. Till next time, cheers.